Now it's Adrian Li, right? And you're the managing partner and founder of AC Ventures.
Yes, that's right.
Just to do housekeeping. And you've got over $500 million in assets under management.
That is correct.
Okay, great. Okay. Welcome to Biztech's Investor Conversation Show. AC Ventures is an early-stage technology venture capital fund that places its primary focus on investing in Indonesia's digital disruptors. Now, AC Ventures manages over 5 funds with assets under management of over $500 million US, with a portfolio of over 120 businesses invested in over the past 8 years. Now, to tell us more about the fund is its founder and managing director, Adrian Li. Adrian, welcome to the show.
Thank you, Brian, for having me.
Now, Adrian, you've got an interesting background. Tell us about your journey prior to starting AC Ventures.
So I was an entrepreneur prior to starting AC Ventures, and I'd started that entrepreneurial journey after completing my MBA at Stanford in 2006. I really spent the last year of my MBA working on my business, which was to use technology to help people study and speak in English in China. So after graduating, I moved to China, and I was a founder of this business called Idapted, where we used internet technologies to connect teachers in the US with students in China and enable them to have one-on-one English training lessons at highly affordable prices. Built that business over 5, almost 6 years before selling it in 2010. After that, I was contacted by Rocket Internet. I ended up working for Oliver Samwer directly, initially building a business in China in the Airbnb accommodation space, and then later moving with Rocket Internet to Indonesia. And really the primary goal of moving to Indonesia was because, having seen the type of disruption that tech and digital had in China in the years of 2006 right up to 2012, when I visited Indonesia, I saw an incredible potential to bring what I'd learned, what I'd seen to entrepreneurs in Indonesia, and hopefully play a role in how digital technologies could create enormous societal impact to a country such as Indonesia. And so when I arrived in Indonesia, I initially started working at Rocket Internet, but my passion was to work with entrepreneurs. Funnily enough, when I initially applied to business school, my long-term goal was actually to start a fund that I could invest in early-stage entrepreneurs and work with them to be able to build those businesses. So in 2014, that opportunity arrived, not because there was a venture scene out there, but managed to convince some of the very large conglomerates in Indonesia to back my first fund, which was called Convergence Ventures. And that initial $30 million fund, which started initially investing in 2014, 2015, ended up investing in over 30 companies, some very well-known startups as well, particularly in fintech. But that was the start of my journey as a venture capitalist, in actually being an entrepreneur venture capitalist, having to help play a role in starting the industry to catalyze the digital industry in Indonesia.
And that's really interesting. I mean, your journey is interesting and obviously shaped your investment thesis and also how you help companies. Could you give us an overview now of AC Ventures, almost a decade later, and what your footprint is like across the region?
Certainly in those early days, it was definitely a struggle for all the questions that LPs, investors in funds, have today about the maturity of our ecosystem. They should have seen what it was like 10 years ago. VCs themselves were pioneers trying to put together capital to invest in founders back then. But it was very, very early days back then. And that first fund, while it was only 30 million, and myself and a partner I brought on board, Donald, who is now the CEO of MDI, a growth fund in investing in Indonesia, we saw a lot of struggle, both from the entrepreneurs, but also even with VCs trying to raise capital and trying to make sure that there was a supply of capital for companies as they continued to grow. But one of the important learnings that I had as an entrepreneur that I saw in China, and certainly you see this in Indonesia as well, is that as an entrepreneur in an early nascent environment, talent is always a critical issue. And so are the many challenges that come at you as a founder in trying to build a business. So we were always about trying to build a platform that could provide resources beyond the check for our founders so as to give them an advantage as they came to building their businesses. Now, if you ask founders, sorry, go ahead.
No, go ahead, Adrian.
And as if you ask founders what their number one challenge is, it's always going to be talent. They say they cannot find the right talent. And of course, most founders in a capital constrained environment aren't able to hire headhunters or even attract the best talent. So we felt that was one of the first places that we would devote our resources as a fund to help our founders. So we actually built a small recruitment team at Convergence, and that had 3 or 4 people in it, and their goal was to find the best talent for our founders. Now, as our firm has grown from that small $30 million fund to now running those 5 funds, our team has grown as well. And one of the first places that we really invested into as our funds got to scale was in a value creation team. So our value creation team helps now not just in talent operations, but also in BD, in finance, in regulatory, in PR and marketing. And we even have a head of ESG that helps with implementation of ESG strategies into our portfolio. So you can see AC Ventures, as we have grown, we've really delivered on that promise that we want to be to entrepreneurs, to founders, that long-term partner that can deliver much more than a monetary check, but really to be partners with our founders in building their businesses.
So Adrian, this is interesting because that's almost a private equity approach to venture capital.
Yeah, so I would say that it's private equity-like in that we are trying to deliver additional resources to our founder. But let's be clear, in our model, we're not taking over the company. We're not replacing management. We're not owning over 50% of these businesses. We are still very much believers that when we underwrite for businesses, not only are we underwriting thematically for a large market and a potential business model that can disrupt incumbents, but also for the founding team. So we are more the rocket boosters that we're trying to put onto that venture on with the founders so that they can build their businesses faster, more scalably, and more sustainably.
Now, Adrian, where are you at today in terms of your fund? So your early fund would be probably either already closed or coming to the end of its cycle. Give us a sense of where you're at with your 5 funds and what sort of sectors you're looking at. What's your typical investment size when you write a check for a company?
So our first funds, they're vintages of, even though it started investing early, they're technically vintages of 2016 and 2018. And as you point out, they're coming towards the last couple of years of their fund life. They were fully invested as of 2019. And so many of those companies have now matured to a scale where we are hoping to be able to realize some exits from those companies, hopefully in the near future. We've already realized some distributions and exits from the portfolio, primarily through acquisitions such as Mocha Post that was acquired by Gojek, through secondaries as well to later stage investors. But hopefully some of the bigger exits are going to come in the next 12 to 18 months as we see visibility for potential IPO exits for some of the portfolio, some maybe even in the US. Now, for the more recent funds, for example, our Fund 5, we've already done first close of that fund late last year, and we started investing in that fund already. That fund is likely to continue investing for another 2 years.
Now, tell us about your involvement with the Penjana Capital Fund, because besides Indonesia, Malaysia is a country that you've identified that's a potential opportunity for your fund.
So I think, Malaysia is a country which I think has been able to punch above its weight in the past. We've seen highly successful entrepreneurs like Anthony Tan come out of Malaysia. In fact, one of our great portfolio companies, Qasim, is initially from Malaysia, and we hope that they will be able to exit, potentially even IPO in the US early next year. So it is a great market for talent. So we had the opportunity to pitch to Penjana, which is the state fund, to be able to create a dedicated fund that allows us to invest in multi-stage opportunities in Malaysia. That fund has so far deployed in about a dozen opportunities, some local Malaysian companies, others regional companies that have entered into Malaysia. And that fund has now almost fully deployed its initial checks and continues to deliver solid returns for them.
Now, Adrian, when you, as you pointed out early in the interview, AC Ventures was one of the early players in the Indonesian tech investing landscape. That shifted from a very nascent ecosystem to an ecosystem where everybody and his uncle was basically writing checks for startups up to about 2021. How has that landscape changed, and what does it look like today in 2023?
That's a great question. I think in the lead up to 2021, you saw asset values across the world get hugely inflated. And I think Indonesia, given its scale and size across Southeast Asia, attracted investors, not just obviously locally and from the region, but actually from investors globally that could see a lot of potential in Indonesia. And indeed, Indonesia continues to represent tremendous potential. But that amount of capital that came in 2021 by certain investors that really weren't local to the opportunity or fully 2 feet in the Indonesian market opportunity, probably represented a peak at that market at that time, where many businesses were that received capital then were overvalued. And so what we've seen since then is absolutely a return to what is a much more functional, much more stable and sustainable market for investing in Indonesia. So-called tourist capital has left. And what remains actually are committed long-term local investors that really truly see the potential of working with entrepreneurs based in Indonesia or around the region to build long-term sustainable products and services that can serve consumers and businesses and create incredible societal value over the long term. And I think with that in mind, there certainly is the potential to create billion or multi-billion-dollar businesses in this market, given the size and scale of the market, but also the potential for venture returns because valuations have all come back to what are more historical means versus inflated asset prices.
Now, through your lens as an investor, obviously there is an entrepreneurial funding winter right now across the region. Well, it's global, but particularly in Asia, where I think a recent survey that just came out earlier this month said that venture capital funding was basically down 48% this year so far, in the year so far. What is your take on it? Where do you see the opportunities for some of these companies, perhaps that really can scale, but obviously have to tide their way through this difficult period at this point of time?
I think right now, first of all, is probably some of the best times to invest. In environments like this, if you look not just in emerging markets, but also in more mature markets like the US, some of the best companies of our digital age were created at times of recession or crisis. Take, for example, Facebook or even Amazon, right? Both of those companies that were created pretty much in times when capital was hard to come by. So when I say it's a tale of two cities when it comes to investing in Indonesia at the moment, there are really two categories. There are companies which raised an immense amount of capital coming up to 2021, some ahead of their time. They were maybe still, from a fundamental standpoint, companies which were working towards greater product market fit, and yet they had raised money which would make them more similar to a Series C company. Those companies, if they were smart and worked hard at restructuring, brought down their cost base immensely and focused and zeroed in with their capital advantage on building the fundamentals of their business. And those businesses will have quite a steep climb to be able to get to a stage where they'll be able to grow into those valuations that they were awarded. They may do it, and it will take longer for them to get to that next round. Ideally, they can get to profitability so they can control their own destiny. Others might not make it. They might get recapitalized, or they may not raise funding at all, in which case it will be very challenging for those founders and also the investors there on what to do with those companies.
And Adrian, I want to take up a point about what you mentioned just now, tourist capital. And tourist capital came in with a thesis of the ASEAN story. And the reality is they looked at China perhaps as a guide to execute across ASEAN. ASEAN is a lot more complicated probably than China. And also you did an op-ed piece on how investors should not be looking at China as a blueprint for success in ASEAN. Tell us about what your thoughts are in terms of ASEAN execution and really investing in ASEAN as a whole.
Yeah, so I think China was an easy analogy to simplify a story several years ago about what could be possible in ASEAN or in Indonesia in particular. But when you look underneath the superficial layer, there are many differences. So for example, China is a closed internet system where you can't have global heavyweights come in, whereas ASEAN is open. So whereas China, you have the opportunity to create Chinese versions of, let's say, Facebook, so you have Tencent, or Chinese versions of Amazon, so you have Alibaba. You don't really have that as much in ASEAN, where both China and US internet companies can come in. I think the other is obviously China's one large contiguous market, which in of itself is larger than ASEAN. ASEAN is a collection of countries which work together, but have very different languages, cultures, rules, and regulations. So it's very difficult to scale a single product across the ASEAN region, which therefore, in our mind, which is why our firm has always focused on Indonesia, we focus in the largest market first, because that's where you're likely to be able to scale the business to a sufficient size before then having to think about some of the other markets to tack on.
And that's a real advantage for Indonesian startups, isn't it? Because the size of the domestic market, just like China, just like India, the size of the market domestically is so huge, they can get to scale and structure before venturing out, just by serving the local market.
And in fact, some startups got to scale just serving the greater Jakarta region before even thinking about the rest of the country, especially the O2O startups, online to offline startups, ride-hailing startups, for example. I think the other thing to really bear in mind is that the regulatory environment is also very different. You saw very high potential industries in China, which faced very difficult regulatory regimes, such as fintech and education, which you haven't seen the same type of strict regulatory environment in Southeast Asia, enabling such companies to survive, not just survive, but to thrive. I think fintech in particular is very interesting in Indonesia because in a market where 70% of the market is either unbanked or underbanked, it really relies on digital approaches to be able to improve financial inclusion and enable the masses to be able to access financial services.
And Adrian, I think we can look to Africa as an example of that because they used mobile and fintech, and literally they were using mobile payments 20 years ago, way before us, because they didn't have the infrastructure around banking, and there was such a large proportion of unbanked and underbanked population.
That's right. And Latin America too. This morning I was listening to an interview of David, the founder of Nubank, and the story of how that company has grown to apparently have 1 in 4 adults using their service as a primary bank is incredible. And really, truly, I think that there is that potential and more in a market like Indonesia, given the scale and size of the population and the need of the consumers.
Now, Adrian, you've been an entrepreneur. You worked with a ruthless entrepreneur, Oliver Samwerk, before. You've had the benefit of then investing over the last coming up to a decade in the region. What are some lessons, key lessons that you've learned, perhaps? And they could be positive lessons, and then negative lessons in terms of mistakes made that you'd like to share with the audience.
So I think when it comes to building a business, I think first of all, we evaluate over companies on three things, and I think sharing how we evaluate is just as important to sharing this piece of advice to founders themselves. The first is when you're looking at a venture backable business. Now, there are many businesses which are not venture backable, and they're perfectly great businesses, but not for the venture asset class. But when it comes to venture, it's important that you're tackling a market that is of sufficient size. If it's just too small a market, then it's hard to get the types of outcomes that you would want as a venture capitalist. And what does that mean for a founder? So a founder who wants to build a venture backable business, you have to truly look at market size, not just total market size, but also what is your particular product and serviceable market size. Because if you're not seeing a way that your business could ultimately get to, let's say, at least $100 million in annual revenues and more, then it may be too small for venture. And then you have to also ask yourself, well, what type of business am I building? Am I building one where I truly want to have enormous impact that would therefore also have venture as part of the story and journey of building the business? Or am I happy also building a smaller business, which is not venture backable, but could be a cash flow business, right? It may not have as much of an impact. But I think really getting to grips with your market size is one. I think the second, and especially important for us as well, is the team. We tend not to back solo entrepreneurs. It's very difficult for one founder to be able to do everything. It's not impossible, but it is very difficult. And it's a very lonely journey in building a business as well. Understanding what your core strengths are and looking to find partners that can be on your journey to help fill in for those areas that you are not strong at, I think is a very important part of the start of starting a company, right? Making sure that you have the right team and matrix of people and skill sets around you is one of the most critical parts of company building. And so, again, from the venture standpoint, is we spend a lot of time trying to underwrite for the right founding teams. Sometimes there are things that are going to be out of your control that you can't forecast. And what do you rely on? You rely on the founding team to navigate their way around those challenges. And lastly, I would talk about the metrics. Now, metrics change with the times, because back in 2021, investors may have been looking at different metrics. I think that founders, particularly of technology-enabled businesses, have so much access to data. You need to build that dashboard and really understand your quality metrics in building that business, because it's not good enough to just see your top line, not good enough just to see your so-called vanity metrics of business growth. But fundamentally, are your users, are your customers, are those businesses, are they coming back and truly getting fantastic value and customer stickiness from your product or service? And zeroing in on those types of metrics before getting venture capital will do wonders for an entrepreneur building their business. Because if you're not getting true signal from your users and you add venture capital and you scale, it's going to be a lot more painful in trying to get back to true product market fit and dialing back all of that capital expenditure.
Adrian, it's been a fascinating conversation, and thank you very much for taking the time to be on the show. But before we leave, any final thoughts you'd like to leave the audience with?
Yeah, I would like to say again and reemphasize that point, that now is probably one of the best times to be investing in the early stage venture asset class. We are very confident that this vintage of 2022, 23 onwards is going to likely be one of the best vintages for this type of early stage asset class. And the reason is because you've had the benefit of all of the investment and maturity of the entire ecosystem, whether it's digital infrastructure or whether it's talent base, all coming together at a point in time where the cycle has come to its trough, right? So valuations are much lower. But at the same time, for entrepreneurs, it's a great time to build, because You don't have to take as much capital, so less dilution. Talent is also cheaper. Lots of talent has been laid off by the bigger giants. It's more mature as well as talent. It's cheaper to acquire users. And you can really have that opportunity to zero in and focus on building truly disruptive businesses at this time. So if you want to start a company and you're truly passionate about what you're doing, now is the right time to be doing it.
On that positive note, Adrian, thank you very much for coming on the show.
Thank you, Brian. It's a pleasure to be here today.
Now, we've been speaking to Adrian Li, the managing director and founder of AC Ventures. I'm Brian Fernandez, and you've been watching and listening to Biztech's Investor Conversation Show. Catch this conversation on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks for tuning in.